Good evening to all of you. It's always a pleasure to welcome you here at Motilal Oswal Towers. And it's an amazing evening to be here because we are celebrating the 10 years of Alpha Strategist. For 10 years, every month, we've been coming out with this report. And we've got a lot of feedback from all of you. And thanks for that, because that encourages us to do better every month. We also have a very, very interesting panel lined up here. Stalwarts in their own respective domains. And we have our chairman, Mr. Raamdeo Agrawal, as well. I can promise you it will be a very, very interesting discussion, and it is in line with the topic of our Alpha Strategist, the edition that we have just published. The topic is called Winds of Change. There are a lot of changes which we have seen over the last couple of years. We saw how the pandemic panned out, and then last year we've seen interest rates going up. So many, many things changing on the ground. So to explore each one of these aspects, I will be posing questions to our expert panel. And once the panel discussion is done, we will have time to open it up to you for your questions as well. So without further ado, let me start with my first question to Nilesh Bhai. So Nilesh Bhai, in the last 1 year, we've seen reversal in rates, reversal in liquidity, from literally a zero interest rate in the US and many other European countries. We've seen the sharpest rise in rates. We've gone from 0 to 4.1. We've also seen quantitative tightening. And obviously, this is on the back of fears of rising inflation. We've seen inflation numbers which we've not seen over the last decade in the US. How do you see the setup from a global context, and what do you think are the implications for India as a country?
So Ashish, thank you for inviting me over here. And let me share some of the headlines which I have read over last 6-8 months about global economy. First, how many of you have not paid your electricity bill or telephone bill on time? Not even one person. But if I would have gone and asked this question in America, 1 in 6 audience would have said, I am late in payment of electricity bill or power bill. Now, generally, Indian Americans, white Americans would have paid their bill on time. That means we are looking at 1 in 3 for Black Americans or Hispanic Americans in payment of their utility bill. Number 2 question. When you go to buy food product in India, do you check expiry label? Few of us may check, but most of us will assume that it is not expired food. But if you try doing that in UK, that will be a disaster, because now, by law, expired food labels have been removed, and expired food products are kept at a separate location in shop so that needy people can come and buy that product. Third question, how many of you know what is a warm bank? We have seen private bank, PSU bank, scheduled commercial bank, cooperative bank, but have you heard of warm bank? The warm bank is a concept introduced in Europe, especially UK, where people who can't afford to heat their home in winter, they go to warm bank, which is essentially church, library, government office, where they heat their offices or places during the winter night so that people can come and stay. अपने यहाँ पे हम ब्लैंकेट डिस्ट्रीब्यूट करते हैं, वहां पे वार्म बैंक है, but it is one and the same. Fourth question, how many of you feel comfortable criticizing government? I mean, यहाँ पे कोई हाथ ऊपर नहीं उठा रहा है, but ट्विटर पे जाओ तो पता चलता है. In Russia, the largest private sector oil company's chairman had criticized Ukraine war. And in 6 months, he fell down from an hospital window and died. He is the 8th businessman to die like this. Suddenly, गिर गया. And earlier we thought that this is happening in Russia. Nowadays, Russians criticizing government in Orissa also are not safe. Ashish bhai, this is the global headline. So things have rapidly changed in global economy. People were providing fiscal incentive, monetary incentive in COVID time. Total liquidity infused was apparently $35 trillion. I haven't calculated the number, but someone whom I follow, he posted that on social media. So I presume he'll be right. Now we are taking back that liquidity and raising interest rates, and everything is going into topsy-turvy. It will be fair to summarize that global economy is in a precarious position. In 2023, as per IMF, one third of global economy will go into recession. The other one third is China and India, which will continue to grow. Balance one third, who knows what numbers they are reporting.
Right. We've also seen the collapse of Nasdaq and the entire tech sector. Obviously, Nasdaq fell about 35-40%, but that masks the damage that we have seen underlying some of the leading companies. I mean, a lot of companies have fallen 70%, 80%. Many of these startups have completely gone bankrupt. Uh, have we seen all the imbalances, or you think some more imbalances are yet to surface? I mean, is there something that we should be worried about?
So it's a very, very tough question. And the factor which has changed between, say, 2020, 21, and 22 is Fed, instead of pumping liquidity, withdrawing liquidity, and instead of maintaining low interest rates, raising interest rates. At 0% interest rate and enough liquidity, any price can be justified. But at 5% interest rates and withdrawing liquidity, how do you justify those valuation? And Fed is, I think, Jeremy Powell is a watcher of old Hindi Bollywood movies. There was a song which said, "Jate the Chin, pahunch gaye Japan, samajh gaye na." Jeremy Powell is exactly implementing that. On one side, he says, I will control inflation. But 6 months ago, 9 months ago, he was saying that this is transitory inflation and there's no need to control. So, जा रहा था transitory inflation, पहुंच गया permanent inflation. Now he's saying that I'll keep interest rates higher for longer. US debt is 31 trillion for government. 1% ब्याज बढ़ा दिया तो $310 billion पे करना पड़ेगा. The total interest rate outflow for US government this budget is $774 billion. Can they pay $1 trillion of interest? Pata nahi. And we are not talking about American consumers who are as leveraged. Here, our interest rate goes from 6.5% to, Sharad bhai, kitna? 8.5, 9. And maturity of the home loan goes from 20 years to 40 years. US में housing loan interest is going from 0.25% to 5% or 6%. वहाँ पे तो पोता नहीं, ग्रैंड पोता भी housing loan भरेगा. So we are in a very, very different world where interest rates have gone up and liquidity is coming down. And that has disturbed valuation all over the world. This is probably one of that rare year where bond में भी पैसा खोया और equity में भी खोया. And unless until Fed goes in the right direction, there is precariousness.
Thanks, Nilesh bhai. Raamdeo ji, I know that you're a keen observer of fundamentals, but finally your decision is always based bottoms up. on a company basis. I have two questions to you. One, like Nitin had pointed out, I think the last 5, 6 years, we've seen a lot of cleanup across the corporate sector in terms of deleveraging, a lot of policy initiatives. So GST got implemented, and many other initiatives like RERA, which I will explore with Sharad a little later. So a lot of cleanup has happened in India, and plus even during COVID, India didn't go as overboard as some of the Western countries in terms of putting liquidity or putting doles in the bank accounts of people. And so this is first part, that is the fundamentals. The second part is in terms of flows. The domestic flows have been very, very strong when FIs have been selling. So how does the setup look to you from the next 3 to 5 years? I mean, how are you thinking about the macros? And because you've observed markets now for more than 3 decades, I'm sure you've seen many interest rate cycles and disruptions.
Good evening, friends. See, my focus is more on the corporate earnings growth. Okay, and your guys showed from 837 to 994.
Right.
यदि वो हो गया तो बहुत सस्ता है बाजार, समझे ना? लेकिन होगा नहीं ऐसा. 994 is completely off the charts. That's my belief.
Right.
People have been cutting the estimates. You speak to Gautam, I think they're talking about 925 types.
Right.
Okay. So if companies keep making money, tons of money, 15-20% growth, then okay, maybe 1 year will correct by say 15-20%, and we don't deliver anything. But in a atmosphere where the world is sinking, Europe is slow for whatever reason, America is trying to fight the inflation out. Now China is just about opening up. That will make life miserable for America for containing the inflation, because
Right.
Chinese demand will come up one side and America has to come to 2%. So that is going to create another chaos. So I think it's a atmosphere where you're not synchronized for earnings growth. So I would think that there will be further cut in the earnings from whatever levels. Definitely not coming to 94, 990, 995. I would think if it is 925, 900, 925, we should be good. So, but still it is credible that India has been able to grow 7%. Earnings growth is positive. Next earnings growth are looking good. So I don't know, is it a different time for India? And for the markets, in the sense that the equity flow which came in last 2-3 years from the retail side, that buffeted whatever selling happened of 2-3 lakh crores from FI, that was completely checkmated by retail. Now what has happened in the last 12 months, index has given literally nothing.
Yeah.
And fixed income is looking good, 7-8%
Yes.
types. So somebody will say, why should I put in equity when it doesn't give anything? And let me shift towards fixed income. Particularly the smart guys, those who are sitting here, they would definitely do that kind of thing. I don't agree with that. Equity is equity.
Right.
You have shown the charts also,
Yes.
how much it gives. Equity, you struggle between 6 and 7%, whereas equity gives your own portfolio, I think, has given 17% or something like that.
Yes.
So clearly, longer term, one has to allocate in equity, and I understand only equity. I don't understand macro, global macro. They're so complicated. And there's so much time goes in reading them, and still you can't make head or tail of it. But focusing on the corporate earnings growth,
Right.
that is much more doable thing. And I would say that outlook was much more brighter 6 months back. Today, it's looking a little more dim in terms of earnings, and we should be very careful whether the earnings growth come or not, because the P multiple, the other derivative, is fully like we are at 22 half TTM basis. So I would think that if by chance retail says that let me take a pause, then there is a problem, which should not happen.
Right.
The SIP flow is still good, but if by chance retail were to say that smart guys are not putting money, let me also not put for some time, and
Right.
let FIs have a run on selling, then we could have a correction. But if your earnings come at 950, 930 and all, I think we are fine. We'll have some correction, and then again the run starts.
All right. So, Raamdeo, whilst I hear your concern on earnings for this year, however, what we saw was last decade, you had nominal GDP growth of 12-13%, but we didn't see earnings growth. Whereas last 2 years, we didn't see too much of nominal GDP growth. I mean, we bounced back, but from 2019, if I take a GDP growth line, we've not grown much, but we've seen huge earnings growth. We saw the EPS go from 500 to today 800 plus. So the next 3 to 5 years, at least the setup looks very good. All the factors drivers seem to be in place. So from a slightly medium term point of view, how do you see earnings pan out?
Yeah, if there is no disruption in the economy and we keep doing 10-12% nominal GDP growth rate, there is no reason why all the corporates put together will not match at least 12% earnings growth. And if oil remains weak, maybe as a consumer, we might have little higher, maybe 12-13% earnings growth. But that's what market is building right now. Market is expecting 10-12% earnings growth, and that's why 22p also looks kind of doable. But if by chance there is disruption, I said, in terms of corporate earnings, like private capex. Now, private capex is not building up the way, the pace at which government expects them to do it. One of the reason L&T was telling me is that in 2008, all the guys they put up the projects, big projects, they're all bankrupt. They're running the bank. So this time around, private capex guys, they're saying, show me the demand, then I'll put up the project.
Right.
And external demand is weak, export demand is weak, domestic demand is also, is picking up in the sense that trickle-down effect is there, rural demand is weak, urban demand is good. So what does this budget do? Government, when you talk to them, they say we are focused on supply side management rather than demand side. So if across the economy, if they talk about only supply side, I think there are certain segments of the economy which needs extremely strong, perceptible demand side management also, which I hope it comes in this budget, because and that can change everything.
Right. And my next question, Raamdeo is, and I'd like to ask the same question to Nilesh bhai after that, is that we've seen few sectors and themes do well pre-pandemic, especially the consumers, the high quality names do well, and it was a very narrow market. But post-pandemic, we've seen a host of other sectors also do well. Like power sector, I was looking at the slide. Last 2 years has done extremely well. Metals did well. Again, we've seen a collapse. So the next 3 to 5 years, do you think fund managers or even investors should think a little differently about sectors, companies? I mean, do you see a trend change?
See, looking back, you can analyze all of it. You didn't tell me this, that power sector is going to do well 12 months back. Okay.
Yeah.
So this will always remain like that. Okay.
Right.
But sometimes you get the global, some kind of trend, global trend, absolutely right. Whether the Ukraine war will drive the sectoral change or Ukraine peace will drive that. Because if the war stops completely, which is right now is in ceasefire,
Right.
if by chance this gets extended and becomes a peacetime, in Ukraine, I don't know what it does. Then the bigger thing is China reopening. Today, Economist has run a headline. China reopening is a huge event for the global economy. Now, how? Because it's a giant. They start consuming all kinds of stuff, and they want to prove that they can grow at 5%. If you want to grow Chinese economy by 5%, it can change. It will mean a lot for a lot of things. Again, the commodity might come into vogue. So we don't know right now how things are going to play out. But wherever the analyst and the manager, they see that demand is good,
Right.
there you have to. And then the second thing is that where the market is. See, in power sector, what happened was they were down in debt. So P multiple had come down to 6, 7, 8. Nobody bothered about them. And suddenly there is a spike in the energy, all kinds of energy demand and price of energy and all. So there is a sudden shock. So one is that earnings might have gone up by only 10-15%, but the P re-rating from 8 to say 12, that has given a 50-60% of return. That is what is happening in PSU banks also.
Right.
So where is the hatred? Where is the despair in valuation? Which sector has the despair? Which is ignored? And that's where if you are thinking that there is going to be earnings shock upside, there you'll get that after 1 year when you see, there'll be a sector which will be 70-80% up. Say
Right.
digital companies, they are down, and maybe people are saying that it will go down further by 20-30%. But if by chance that turns around in a different way, because they have had 70-80% kind of decline if by chance there is a turnaround in their path to profit or things like that, or there is a change of opinion worldwide about the digital companies, you could see that sector could be doing very well. Or say oil refining companies, they've seen tens of thousands of crores of losses. And if by chance government says that, okay, that loss is not because of your inefficiency, we'll make it up, and here is a check for entire losses incurred by you. So those kind of things can completely change low P multiple company and give you boost in the marketplace. And when we analyze after 1 year, we find that 50-60% returns have come from these kind of sectors. So it's a very volatile scene to see a lot of predictable movement apart from the performance of the banks. I don't see many places where you can confidently say, okay, for next 3 years, this will grow at 25%, and hence let me load up on this particular sector.
Right.
There are very few visible places.
Right, right. Nilesh bhai, same question to you. I mean, are you seeing any discussions within your fund management team in terms of positioning of portfolios? Is there a need to rethink? Like Raamdeo ji said, last 6 months PSUs have seen a big bounce back. So how are you looking at your portfolios?
So, see, at our size, we have one which is core portfolio. That's good management, good business model, good ROE. Now, we might as well bear underperformance for a while, then sell those shares, because you can exit good shares, but you will be finding it very, very difficult to enter those shares. The impact cost is very, very high in liquidating good shares. And obviously, there is a satellite portfolio where you go to fifth gear or go to reverse gear depending upon your outlook. Now, we failed to capture PSU bank rally across most of our funds because we thought over a longer period of time, private sector banks will compound wealth. And we have stuck with that position. I bear 12 months of underperformance, but I'm not going to sell private sector banks to buy public sector banks. And just ask in this audience how many of them have their bank account in public sector bank, and how many believe their kids are going to open bank account in public sector bank. The day I feel that majority of audience are in PSU bank and their kids are also going to go to PSU bank, I will definitely change my view. But till such time, I'll remain with private sector bank. On the other hand, we captured defense PSU pretty well. We made our highest profit in defense PSU because there was no private sector opportunity
So is
there.
defense a theme? Are you thinking of defense as a big theme over the next 3 to 4 years?
So as Raamdeo ji mentioned, we took a call and it worked out.
Right.
We took a same call on PSU bank and it didn't work out. So at the end of the day, Ashish bhai, some of your calls will work and some may not. In my opinion, despite having long position in defense PSUs, I think from here onwards, they will be compounding return. They won't be giving multifold return. Same thing will probably happen in banking system. It's going to be compounding return, not multifold return. But can IT and pharma provide you better return? I think right now it's catching the falling knife. IT may still underperform the market in the near term. But if you can average yourself into this, you will be able to get the quantity which you want. And hopefully you will average yourself in so that over a period of time, it can deliver good return.
Right. A related question, Nilesh bhai, which we were discussing on flows. I mean, you've seen, retail distribution for a long time. SIP flows are now hitting 13,000 crores a month. How do you see this panning out? Do you see this sustaining? Because even on the broking side, we've gone from 3 crore demat accounts to 10 crores. Yes, so last 3 years, all of this has happened. SIP flows, so 13,000 crores now every month. Yeah, yeah.
So आशीष भाई एक ही चेंज हुआ है. Earlier when market used to correct, we used to go to investors and say कि घबराना मत, long term story ठीक है, आज थोड़ा नीचे गिरे, कल ऊपर आ जाएंगे. Now when markets correct, people come to us, नीलेश भाई डरना मत, ये गोरे को बेचने दो, हम पैसा भेज रहे, खरीद लेना, साफ कर देना उसको. तो चेंज इतना ही हुआ है, कम्युनिकेशन इज द सेम, खाली पार्टिसिपेंट बदल गए हैं.
Right.
And on a serious note, there is a tremendous maturity with retail investors. It is amazing maturity in a rising market. And I'm just giving number from a contextual point of view, so don't say that this is expensive market or something like that. But when the index was going from, let's say, 17 to 18,000 Nifty, the flows were SIP flow minus redemption.
Yeah.
So we were getting 13,000 crore in SIP and 10,000 crore redemption. So net flow was only 2,000, 3,000 crore. And when index fell from, let's say, 17 to 15,000, it was SIP plus subscription. So 13,000 के साथ लमसम में 10,000 crore और आ गया, and I had to invest 23,000 crore. In 30 years of my career, for 28 years, I used to get money when I didn't want to invest. And I used to sell to fund redemption when I didn't want to sell. Last 2 years, game has changed. I get money when I want to invest, and I get less money when I don't want to invest. So there is tremendous maturity at retail investor level. And my feeling is that as markets correct, this year also, despite fixed income, as Raamdeo ji mentioned, with correction, equity will look attractive and retail allocation again will shift back to equity. The maturity shown by India's retail investor is far more than all the Gora investors put together.
Right. So moving on to a very large asset class in India, and most Indians love real estate. So last year, Sharad, whenever I used to meet Sharad, month on month, I mean, the numbers he would give me is all builders are having record sales in real estate. So is the love for real estate back? What is driving this buoyancy in real estate?
So first of all, thank you very much for having me. I think real estate cycle has to be seen in last 10 years. It has to be seen a decadal cycle from 2013 to 23. Last 2 years, the sales have been excellent. And I was telling Nilesh bhai before this, when we were starting, the numbers still are extremely small. See, what has happened, Ashish, is that the whole market was unorganized. The way this business was being operated, there was lack of trust, lack of liquidity. And to the credit of policymakers, between 2016 and 18, in a 22-month period, the policies which ideally should be implemented over a decade, they implemented in 22 months, whether it was demonetization, followed by GST, RERA, Benami, and of course, ILFS is not done by them, but that also played a role in consolidating the industry. So I think all those things which got packed in those 22 months, and now we have a regulator. In fact, Raamdeo ji and Nilesh bhai is there, and I keep giving example of capital market. Whenever I speak to my father, who's in his 70s now, and I tell him that you should invest some money in equity markets, because I would know some bit of it, his standard answer is equity market mein mujhe kabhi invest nahi karna hai, because his investing period would have been 80s, I'm assuming. And how a regulator in form of SEBI and an institutional framework of investing, which is mutual fund, has changed the way the investing happens. Real estate had that moment in 2017 when RERA came into place. It's a very large asset class with a lot of public interest. It will take time. One thing that I would like to mention, some numbers I will just add. After this bumper year where people are talking so much about residential sale, all 8 cities put together would have a total sale of 300,000 units, 3 lakh units. This number in 2011 was 4.5 lakh units. This number between 2013 and 20, average was little over 2 lakh. We are just scratching the surface. The total value of the entire residential sale will be like 3.2 lakh crore. It is less than 1.5% of GDP. I think we are looking at a slightly longer period growth, not speculative. And that's where the request, and we keep advising, telling our investors is that residential real estate is for staying. It's not a speculative investment. It's not a speculative asset class. And the maturity that the investors are showing in investing into capital market is also coming here. There are several other ways to participate into Indian real estate, which we will speak about, whether it is private equity fund like ours, or there are REITs, there are various debt products which are there, or there are several listed companies which are there. So I think it's sustainable. The only thing in the short term is the rising interest rate. So far, it has not impacted. Month on month, sales have been stronger than the previous month, but home loan rates have moved from 6.5 to 865. In fact, I was speaking to Anuj Puri, who is the chairman of ANAROC, and they have done a survey across some 30,000 home buyers. Until 9% home loan, almost 97% of the respondents said they're not going to relook at their decision. Between 9.5% and 10%, it falls off the cliff. Almost 80% says that they will reconsider their decision. These were broadly the numbers. So I think if it start touching double digit, hopefully it should not go that far. But overall, residential real estate seems like on a good wicket. Seems like all the policy changes over a period of last 5-7 years should give us a sustainable at least a decade.
One of the points you made, Sharad, was there has been consolidation of the real estate market across cities. We've seen the number of developers shrink. RERA was possibly one of the early catalysts for this happening. Do you think the consolidation is over, or we are yet to see more consolidation?
So Ashish, at one point of time when I started in 2001, and I would say around 2010-12, the number of developers had breached 50,000 in India. There were 50,000. There is not a space for so many developers, and because there were no entry barriers, most of the developers' skill was the ability to buy land and get approval. Then it was left to the God. There were no protection for the consumer rights. So I think what we have seen, and RERA played a catalyst, I think consumer behavior also. When eventually people have learned it hard way that they are ready to pay some bit of a premium, but they want their house. So in terms of number, top 30 developers in each city, market share have moved from 17 to 47% between 2016 and 23. So COVID played a role. ILFS crisis, because the capital was then going to selected few. I think the entire ecosystem is stacked in favor of scale, institutionalization. Whether it's not only the home buyer preference. I know of vendors, and we have in our private equity some of investee companies which deal with developers, whereas a vendor, I don't want to really deal with certain set of developers. So it is home buyers preference, vendors, lenders, the entire ecosystem. But the size and scale, it's a very local subject. So it's not going to go path where people will see that there are only 50 developers in India. But my sense is over a period of next 7 to 10 years, top 30 developers in each city will be closer to 65 to 70. Either it will be that, and then the balance will be boutique. Small, like say Bandra. So a guy who's wanting to do business only in Bandra and Khar, doing 2 to 4 projects, either that will be the scale or there will be large scale. But 47% is fairly large, and that we are seeing in some of the listed companies on their numbers as well. But I think there is some more journey, but the journey will slow down now.
Right. So we've seen a lot of volume velocity in the real estate markets across India, some price velocity. So two questions to you. One is, if somebody is directly investing in real estate, buying a home or even investing, let's say in a second home, where do you see opportunities? Second, as a fund manager, because you've been somebody who's been early to spot trends. I remember you were the first person to do a pre-approval fund, and then we did a working capital fund. Where do you see opportunities from an investing point of view?
So I firmly believe that residential real estate, buying into apartments, trying to make money off it, it's something which should be avoidable. Not only the transaction costs are very high, it's a complicated process. See, what has happened is, over a long period of time, say 35, 40 years, residential real estate has given return closer to 10%. 2 odd percent of rental yield, 8 to 9% of capital appreciation. Now, what happened between 2002 and 12? People made super normal returns. We just took off. The newer cities came about. I remember, like, Bangalore was a city of lakes and gardens till late 90s. So I think the return made during that 10-year period, which was closer to 25%, was a abnormal thing. If the return expectation is between 8 to 10%, owning physical asset, going through the entire grind of putting it on rent and dealing with the brokers, then do it. Else you are better off doing through financial real estate. Uh, that's what I believe. Having said that, if people still like to do it for the touch and feel and want to have more than one asset for their use in the future, outskirts of any city from a long-term perspective will do well. Some of the IT cities, the kind of wealth which is getting created will do well. Uh, I would say Bangalore, Pune, Bombay is will do. It's like 5 cities rolled into one. I think some bit of it is already played out in luxury. I think second home is hyped. It is all COVID impact. People were sitting at home. The kind of price rise that we have seen, the way the world has come back, I'll be a little skeptical on the entire second home stuff. It's not only outskirts of Bombay. I know people are done so much stuff in the hills and the tea gardens and all that. Who has time to go? I think people will probably rent it out and go. But have a moderate return expectation. Then one can look at any of the 2 large IT cities or any suburban location in Bombay.
And how do you look at commercial? Because we're hearing conflicting views, and I'll
Yeah,
tell you where
it's
I'm coming from. On one side, IT is the biggest consumer of commercial real estate. So one, there is a global slowdown. Second, we hear that in the IT industry, still a large population works from home. And we've seen a lot of global companies cutting workforce or even giving up commercial real estate. So your view on commercial real estate, which is IT led, and the office space.
So in India, total grade A office space is 600 million square feet, of which almost 65% is leased to IT or IT enabled companies, which is largely offshoring in nature and some bit of domestic as well. And the almost 1/3 of it is for non-IT financial services, pharma, service industry, and so on and so forth. The backbone of the India's office space is IT. And of course, COVID had a big impact on it, and work from home. Ashish, till 10 months back, the occupancy in IT offices was 12%. It has moved to 50% plus now. Most of the employers want to get employees back. It's the choice that the employee is making, but collective effort is to get the employees back. Till COVID struck, the highest amount of leasing that had taken place was in end of March 2020, just 10 days before the COVID, which was 42 million square feet on a base of 600 million. This financial year, we'll do all-time high between 58 to 60 million square feet of leasing. So there is a conflicting thing. What we need to see here is, and when I speak to some of these large occupiers, see, when you speak for a guy who's renting it out in 1 BKC, is running a 3,000 square feet office, he is looking for that year PNL. अभी घर पे जरूरत नहीं है, employee घर से काम करता है, 2 साल के बाद वापस ले लेंगे. But some of these large occupiers plan for 7-10 years. And the basic fundamental thing here is that the employees will come back. If not now, in a year and a half. Some of these leases are signed with a very long-term thought process. One. Second thing, what has happened is that the earlier per employee capacity had fallen to 75 square feet. Because of COVID and some of the other global needs, it has gone above 120. Having said that, I will still watch. This number from 12 to 50 has moved in last 1 year. It need to go up to 75-80% for sustainable. In commercial real estate also, and more so in commercial real estate, I have known HNIs and large investors wanting to own physical commercial real estate. I would say the earlier they start their journey towards REIT, the better it is. I think REIT is a fantastic product, one of the better products that has come out and established. Total REIT market cap will not be even 1 lakh crore in India. InvITs and REIT put
Do you see
together.
many more REITs listed?
There is. See, REIT is a beautiful product from a perspective that if you want to make returns which sits between debt and equity, REIT is that product, and it'll get size and scale. And I'll keep giving examples that we are not inventing anything new. US is the mother of all financial inventions. This came in 1962. They've done and dusted with it. It had played out exceedingly well globally as well. So if you want to own a piece of office space in BKC, or like there is a large mall in Delhi called Select City Walk, if you want to own a piece of it, REIT is the only way. Most of the people are not aware, which is surprising, that the tax on REIT is zero. If you are receiving dividend, and there is a special exemption which has been done where the dividends received on the REIT payouts is tax exempt, and it can be sold on a click of a button. So I think REIT as a product needs more adoption. It's sad to see, but unlike the flows on the equity side, REIT is predominantly owned by global investors in India.
Right. So Raamdeo ji, whilst we have seen net selling by FIs in the listed space, the FDI money has been quite consistent. And we've seen close to $40 billion coming last year. You run a very successful private equity practice as well, and you meet a lot of unlisted companies. Do you see more value in the unlisted space? There is a lot of M&A activity happening. A lot of private equity funds are raising money. How do you view private equity as a asset class and space?
Yeah, fortunately, we don't do the digital side of it, where most of the massacre has happened worldwide and India also. And I was told that the private equity funds who have given money to these funds, they have marked up the valuation. They have yet not corrected it with their funds. So one has to be very careful. And it's a global practice. Most of them, they have not corrected it. So if last round was $8 billion or $9 billion, and now they would be happy to get even at $3-4 billion. But they have not corrected the valuation to $3-4 billion. And hence the statements we are getting is at that $9-10 billion. So I think digital side, that's the situation, and maybe further correction might happen. But I think non-digital side, the consumer business or whatever, those businesses actually have not seen much correction in the private equity valuation.
Right.
Because they compare with the listed counterpart. So if a ceramic company is coming, and if ceramic company is doing very well here, you don't expect them to give a huge discount. So we are seeing a lot more deal flow, but we are not seeing, and there is ample bidding, and there are a lot of funds raised. We raised 4,500 crores, but global private equities, they have lots of funds. In fact, for India, they're saying they have unlimited funds. I keep meeting people, they're talking about they will have $1 trillion, of that 10% will come to India. So they were asking me, how do we do it? And they're not even started. So a lot of funds are waiting to come into India in the private space also.
Right.
So I don't see that side activity slowing down, except for the digital side, which is extremely global in character. So what happens in US, in NASDAQ, what happens in their unlisted digital companies, I mean, that will set that tone. All these loss-making companies, everybody is saying we are good for next 6 months, we are good for next 1.5 years. So what finally happens? So these companies, that will set that trend on the digital side.
Right. And do you also see, like in the US, I was reading a report, a lot of money from the active funds have moved to private equity or index. And a lot of companies get delisted in the US. There are these buyout funds. And what we've seen is alpha creation is much more in the unlisted space. Do you see something like that in India? Because even in India, what we've seen last 3-4 years, the passives have somewhere...
India, I don't think. I think US went through craziness in unlisted space in last 5, 6 years. Looking at, I mean, everybody is trying to buy the next Facebook or next Google, that kind of thing. And that, I mean, there is one Google, there is one Microsoft, there is one Facebook. And in that, trying to buy one Facebook, people have amassed a lot of Facebookings. So I think that correction, they are not realizing it is gone and they are never going to make money. So how this entire thing will turn out, and still they're talking about slowing down the economy, coming to 2% inflation. As Nilesh Bhai said, their already interest bill is $6 billion, $600 billion. So they cannot afford to pay another trillion or something like that by way of interest. So clearly they will definitely see to it that inflation goes down to 2%. When the US or global inflation is 2%, I don't think we are going to be at 6%. We will be more like, say, 4.5. So one of the things is that India is at 10-12% compounded growth, irrespective of what happens in the world. So all this recession and everything we talk, these are two different stories. For us, 4% is depression. For them, 4% is boom. So, I think we are, I don't know, Nilesh Bhai would have view, but I think all this global terminology or whatever is happening in US, we try to import too much down here. And here reality is very different. I mean, 5-6% inflation is given, even government projects like that. So that kind of level of inflation, 4-5-6% of real growth, that's the way of life. So we have to differentiate between the recession in US and kind of a slowdown, little slowdown from 7% to 5% in India. I think these are two different things. So I would keep that in mind. And that's why I'm more focused on where this 10-12% growth on 270 lakh crores of GDP this year, when you grow at 12%, that gives it another 30 lakh crores of output next year. And in that 30 lakhs, who are the guys who are going to thrive? I'm more focused on that rather than trying to figure out what's going to happen in US.
Right, right. Um, Nilesh bhai, question to you. Like Sharad said, real estate has seen a revival last couple of years. We've seen fixed income coming back in a big way last year. From 5% FD rate, today banks are offering 8%. It's very easy to construct a fixed income portfolio with 8%. Even we are seeing a lot of flows, incremental going in fixed income products. So how do you, I know you're a big believer in asset allocation. I've seen you speak many times on asset allocation. Gold has been the best performer last year, 13% in rupee terms. So how should investors think about asset allocation? And is fixed income, should fixed income be an important part of the portfolio?
So 2023 will be choppy water. And wisdom suggests that in choppy water, you need to have a good anchor. That anchor in 2023 will be either debt or gold or both. In gold, the Russian central bank experience is visible to all. You had about $500 billion of US dollar, Japanese yen, GBP and euro security, and $150 billion worth of gold physical in your custody. When you invaded Ukraine, that 500 billion got frozen and only this $150 billion came handy. Every central bank is now buying gold. Now Taiwan has a vision on, China has a vision on Taiwan. They have $3.5 trillion of FX reserves. Will they not put some money in gold? Answer is undoubtedly yes. So the central bank buying itself will continue to support gold, and hopefully that will provide good return to investors in gold. While investing in gold, just remember one thing, there is 16% import duty or tax component in rupee gold prices. If tomorrow government decides not to incentivize gold smuggling and brings those taxes to zero, you will lose 16% of rupee gold value in one single day. Subject to that risk, it is worth investing into gold and silver in 2023. Fixed income again looks attractive. As Raamdeo ji mentioned, it's very, very difficult for central bankers to keep interest rates high for longer. They are definitely making that statement, but I don't think so. They will be in a position to keep rates higher for longer because of the debt they have generated. Hence, if interest rates are going to come down, it makes sense to invest into fixed income. This year, the return differential between debt, equity, and gold, silver will be fairly minimal. So, post budget, my recommendation will be to invest in longer maturity, longer tenure debt, maintain asset allocation. Equity is buy on dips market. Equity is at least 5 year plus investment horizon. Debt is post budget longer maturity market. And anything less than 5 year horizon, please invest in debt or gold and silver. Gold and silver, just remember, you could lose 16% in one single day if government decides to disincentivize gold smuggling.
Right. Since you mentioned the budget, any big expectations, Nilesh, by budget round the corner?
So expectations to bahut hai, but how much FM will deliver, that she only knows. But first expectation is not to increase capital gains taxation. In India, we need to encourage capital creation, and we are levying about 35,000 crore of STT. And then there is 10, 15, 20% kind of long-term and short-term capital gain. So please don't tinker with capital gains. Second, we need to focus on tax compliance rather than tax collection. At 43% tax rate, it's already reasonably high. But then there are various tax loopholes which can be plugged. To give you a small example, there is about 75,000 crore to 1 lakh crore of market linked debentures. They convert interest income into capital gain. Now assume person who is converting interest income to capital gain is at 40% tax bracket, and capital gain will be taxed at 15%. So effectively 25-30% is your tax saving. It's 2,500 to 3,000 crore a year. Please stop that instead of raising long-term capital gains tax rate or short-term capital gains tax rate. The other thing is monetize government's resources. I mean, all of us want to believe that we are better than Pakistan. But do you know Pakistan is 50 years ahead of us in one particular aspect? 50 years. So in 1965 war, when India and Pakistan went to war, we both nations came out with something known as Custodian of Enemy Property Act. So all those people who migrated to Pakistan and left their property here, we confiscated, and vice versa in Pakistan. Pakistan liquidated all enemy property in 1971. We are in 2022. There are more than 7,000 properties which we have seized but not liquidated. It is worth more than 1 lakh crore.
Wow.
And you can imagine the properties will be encroached. 50 साल के बाद टाइटल भी मालूम नहीं पड़ेगा कौन सी प्रॉपर्टी कहाँ पे है. Can we not beat Pakistan in this? Can we liquidate 7,000 odd custodian of enemy property assets, raise 1 lakh or 1,50,000 crore or 2 lakh crore and fund our budget? This budget also has to reassure investors that we are on the path of fiscal prudence. Today, India is getting premium valuation. We are like Surya Kumar Yadav. Investors expect us to hit 4s and 6 at every ball. Now, our budget has to meet those expectations in terms of fiscal prudence. So it's a delicate balance which finance minister has. But if she plays her cards well, India will get differentiated vis-a-vis rest of the world.
Thanks, Nilesh bhai. Raamdeo ji, first, any expectations that you have from the budget? I know you don't follow the budget that closely. You follow it, but You don't make investment decisions around it. But any expectations?
No, I think we have been telling in whatever interviews and all, don't disturb because the party is on, retail investors are coming, everybody is happy, and now I don't know why they have to bring it up every time around the budget time, and then nothing comes in budget, and we have fun. So my sense is they're smart people, they're not going to do anything. Maybe they might make a little more adjustment on non-financial assets kind of thing. Because there, I think the real fundamental call is that why should different asset classes should be treated long-term capital gains differently, isn't that? Because here it is 1 year, and other places it is 3 years and something like that. So make them 1 year, and the controversy will be over. Because once you make it say 2 or 3 years, then you're out of sync with the global practices, which after a lot of effort you have come to the global level. Now again you'll go back to, so I think these are media created kind of a controversy. I don't know whether it's active thought that they should consider all this. So I don't think anything is going to happen on this round, but let's see, it's just about 2-3 weeks away.
Right. So, Raamdeo, no equity discussion is complete without reminiscing your friend who famously said, "Apna time aa gaya hai," Rakesh ji. And you are famous in saying, "Don't bet against India." So, final words, how should people think about investing in equities next 7-8 years? Abhi story baki hai. And how strong is the story according to you this decade?
Yeah, she's good. You know, what happens is when you look 10 years back, consolidated, you cannot believe everybody has gone through the 10 years of investing. Nobody could have thought that index would be here. I have seen index going from 100 to 60,000. I bought my first stock in 1980 when Sensex was 100. Today is 60,000. So, and what have we not gone through as a nation? We have gone through coalition politics of 30 years. We have gone through bankruptcy in 92. We sent our gold. We had kind of a Pakistan on our head day in, day out. So today we are a country with 550 billion. Despite COVID, we are still left with $550 billion of reserve, probably $560 billion of reserve. That is the most precious thing a country can have. We have very stable, very powerful government, which is being liked by Russia as well as America. You know, I mean, this is a very unique situation that India is in good books of both, and very stable government, and most likely that we'll have another 5-10 years of stability under this government itself. So I think it's a very opportune time, and we are going to do well. How well? The past says that 12-13% kind of equity return, and half of it in fixed income, 6.5 in equity, debt, and 12%, 13% on equity. I don't think in longer run, whether it is 3 years, 4 years, 5 years, you can keep doing your numbers. But I think longer run, that equation is not going to go very different. And that helps. That's how I allocate. I suggest people, if you want 12% return, come 100% in equity. You want 6% return, don't bother about equity. If you want 9%, go 50-50. It's that simple. I mean, in terms of asset allocation. So I still believe that 12% longer run, not next year or something like that, but longer run, 5-6 years. I think India's time has come actually. I mean, which big country is there which is going to rise? Every 20-30 years, there is one big rise. Last 20 years belonged to China. Now I think it is India's turn. Everything is going right. I hope the story is going to happen. So even if the story doesn't happen, we'll get 12%. If by chance story happens, then it is going to be plus. That's my thought.
Great, great. Thanks, Raamdeo ji. That's a good note to end the discussion on.